That's closing bell on Wall Street, and now it's Market Domination Overtime. We are giving you full coverage, all the moves, get you up to speed on the action from today's trade. With us now is Yahoo Finance's very own Jared Blikre, joining us here to break down the moves today. Jared.
Thank you. Well, let's go to the Wi-Fi Interactive right now and check out what the Dow is doing. We got it down about 220 points or 0.5% for the day. Let me show you what happened over these 4 days, holiday shortened week, down about 1/3 of 1%. And then here's the NASDAQ, just about break even for the day, still holding on to gains of 1% for the week. And the S&P 500 still holding on to gains of about 1/3%. And that's also how much it lost today. I should mention too that right after the report on the open of today, we got record intraday highs in the Dow, NASDAQ, and S&P 500, but we definitely gave those back. Now, let's take a look at the bond market, because this is what was really moving this week. The 10-year T-note yield down from about 4.25, 4.3, all the way down to 4.09%. That's a big move right there. That's on the long end. And then on the short end, we're going to look at the 13-week T-bill yield. That went from 4.05% crashing down to 3.91%. That is the short end of the curve. Those are those rate cuts getting priced in. And now let's take a look at the sector action. And let's get the sector action up there. That's the NASDAQ 100. Here we see real estate in the lead position. It's been a leader all day, up 1%, followed by materials, and then leading to the downside, financials and energy off almost 2% there. And then we'll also take a weekly look here. Communication services, where you find Alphabet and Meta. That was the leader, up 3%. And then in second place, Amazon and Tesla fueling XLY. That's consumer discretionary, up 1.5%. To the downside, energy was the biggest loser, off over 3%, and then financials in second place. I'm going to leave it with the NASDAQ 100 over the entire week, and you can see up there, NVIDIA lost a little bit of steam, down 4%, but Alphabet, after that favorable antitrust ruling, that was up 10%, Apple holding on to gains of 3%, and Broadcom really stole the show today, overnight after those earnings, up 9% today, and about 12% for the week. And I'll send it back to you on that.
All right, thank you, Jared. Fed independence remains in focus. Our next guest has said Fed independence is, quote, sacrosanct. Let's welcome in now Phil Orlando, Federated Hermes Chief Market Strategist. Phil, welcome to the show. I want to get to your views on the Fed, of course, Phil. But first, your take on that jobs report we got this morning, Phil. I want to get your take, and I want to get what you think of the market's response to that.
Well, the jobs report this morning was terrible, but it was not terrible in isolation. We've seen deteriorating labor market data over the course of the last couple of months. And then just this week, if you looked at the totality of the data, look at it as a mosaic. The initial weekly jobless claims were poor. ADP in August was half of it was in July. The JOLTS report was much weaker than expected. The Challenger layoffs were significantly higher. So there really wasn't any place to hide in the labor market. And this is not a surprise that we've seen the labor market data deteriorating over the last couple of months. You look at the last 4 months, for example, non-farm payrolls are averaging like 25,000 a month. Earlier this year, the first 4 months of this year, they were up 125,000. And last year, we were averaging about 168,000. So again, the Federal Reserve up until now has been sort of ignoring the deterioration in the labor market, seemingly focused more on their concerns about inflation. But today was too significant a wake-up call. And that's why I think the market has come to the realization that we're going to start to get some rate cuts starting in September.
So the labor market has been cooling, Phil. What does this all mean for the broader economy?
Well, the broader economy has been slowing as well. During the first half of the year, we'd like to think that we're sort of troughing here in the second quarter and starting to turn up. If we look at second quarter earnings, which are just about completed, our earnings are much better than expected. Revenues were much better than expected, up about 6% on revenues, up about 12% on earnings on a year-over-year basis. And we think those earnings are now going to accelerate over the course of calendar 26. So we can sort of separate to some degree what's going on with the labor market from the broad economy. So your follow-up question is, well, how can that be? You can probably point to two things. Number one, Trump administration has been making a concerted effort to deport immigrants, some immigrants convicted of crimes, et cetera. So theoretically, they were part of the labor force. We studied this pretty closely, and the participation rate among the immigrant population is down pretty sharply over the last year. The second thing is DOGE. There's been a pretty significant decline, about 100,000 decline in federal employees over the last 7 months, and that number is likely to increase over time. So those are two pockets that we can point to that's reducing employment levels.
Fed independence, Phil, has been a subject of great conversation, including just today on this program with another economist. I'm curious to get your takes there. Are you worried about Fed independence in the way that some economists and strategists have been this week?
I am concerned about Fed independence generally, and I thank you for using my word sacrosanct. I firmly believe that. You do not want members of Congress or the White House making monetary policy decisions. And the reason for that, very simply, is that we know how they would decide. They want lower interest rates. They want to goose the economy. They want people working. Why? Because they're interested in their own self-interest. They want to get reelected. They want their party to remain in power in Washington. So, inflation be damned. Whereas the Federal Reserve, is looking at this dual mandate and this Phillips curve trade-off. They're trying to manage full employment and moderate levels of inflation. So I want the Federal Reserve in charge of interest rate policy, not the president, not Congress. One way to resolve this problem, in my view at least, is that we've got term limits on members of the Fed. We've got term limits on the president. We don't have term limits on members of Congress, senators and representatives. I think now is long time past that we ought to establish 12-year term limits for senators and congressmen. That way they're making decisions on the basis of what's right for their constituencies, their states, the country, not how can I prolong my political career in Washington to 30 or 40 or 50 years?
I know, so there is concern, Phil, about Fed independence in some quarters. Do you see any evidence of that concern, Phil, in the financial markets?
Right now, I think the concern that we have is that this Federal Reserve, the Powell Fed, over the last 4 years, has made a series of policy errors. You can go back to the spike of inflation back in 2021. The Federal Reserve kept telling us that spike in inflation was transitory. Our work at Federated Hermes suggested that we could see nominal inflation peak out at 8 or 10%. We ended up peaking at about 9%. The Federal Reserve didn't start hiking interest rates until March of 22, probably a year too late. And then look at the situation last year. We felt that the Federal Reserve should have cut interest rates in July. We would not have cut interest rates in September. And the reason for that, very simply, is the Federal Reserve historically, to avoid the appearance of impropriety in a presidential election year, abstains from changing policy in between Labor Day and the election. And we were fine with cutting rates after the election, November and December. The Fed didn't do that. They cut rates 50 basis points in September. The timing of that just didn't look right. And then fast forward to where we are now, it was apparent to us that the labor market was deteriorating over the last several months, and our concerns about inflation were much more sanguine than the consensus, I believe. Our view was that you had a situation where the tariffs were going to create sort of a one-time effect, not a continuous effect. And therefore, we felt that the Fed should have been more focused on the deterioration of the labor market and probably should have started to cut rates in July, as Chris Waller and Mickey Bowman had suggested. Those are just three examples that I think individuals like us who are Fed watchers are very concerned about the policy decisions of the Fed. And I think members of government, particularly the Trump administration, are looking at that, saying, well, we need to get some people in there that understand the economy better and can make better interest rate decisions in order to make sure that the labor market and inflation are where they need to be.
Phil, always great to see you and to have you on the show. Enjoy the weekend. Palantir is one of the hottest stocks in the S&P 500, but for many investors, it's hard to describe what it actually is. Yahoo Finance tech editor Dan Howley is taking a deep dive into Palantir and breaking down what the company does.
Founded in 2004 with funding from the CIA's not-for-profit venture capital arm In-Q-Tel, Palantir is named for a collection of mystical orbs in J.R.R. Tolkien's The Lord of the Rings universe that can see both the past and present and allow users to communicate over vast distances. That's not exactly far afield from how Palantir itself operates. The company is able to pool and organize client data, which helps them either form or point them to possible solutions for their various needs. And it's been quite lucrative for Palantir. The company offers 4 main software platforms: Gotham, Foundry, Apollo, and its artificial intelligence platform, AIP. Government defense and intelligence agencies and law enforcement use Gotham to combine information from various sources, finding previously unseen patterns that they can use to determine outcomes and suggest actions in their operations and investigations. Foundry pulls data from Palantir customers' own disparate sources and organizes it to help them improve decision-making and processes. Apollo is a cloud service that allows the company to continuously provide software updates and features to clients. And AIP allows Palantir customers to create custom artificial intelligence agents that can help organize and take advantage of their data via integrations with Foundry and Gotham. The company works with a wide swath of organizations, including the UK's National Health Service, the World Food Programme, and Airbus. But Palantir's most well-known clients include those in the defense and intelligence sectors. Palantir has also faced heavy criticism for its work with immigration and customs enforcement, as well as with the Israeli Defense Force. CEO Alex Karp doesn't shy away from Palantir's more controversial work either. During one of the company's earnings calls, he said, "Palantir is here to disrupt and make the institutions we partner with the very best of the world, and when it's necessary, to scare enemies and, on occasion, kill them."
More Market Domination Overtime coming right up. Goldman Sachs is sounding a little more cautious on that hot AI trade in a new note out today, in large part citing valuations. This as the investment bank is gearing up for the start of its big annual Communacopia Tech and Media Conference next week. My colleague Brian Sazi spoke to Eric Sheridan, Goldman Sachs co-head of TMT Research, about that tech trade.
I think there's a couple things around the labor market that impact the technology field. Number one, most of the companies I cover continue to be balancing legacy operating cost efficiencies with the need to reinvest in the forward AI curve over the next 3 to 5 years. So you have sort of a push and pull, the way these companies talk about legacy costs and forward investments that can have an impact on employment numbers. I mean, most of the companies I cover have had low to no net employee growth over the last 6 to 8 quarters as they've realigned their organizations for where they're going over the longer term with respect to AI. It's sort of pulling OPEX out of the business model with an eye towards putting that capital back into capital expenditures that go toward the infrastructure layer.
Really enjoyed your team's AI note this morning. I believe it was by Ryan Hammond and a very large team doing work on this. Sounding the alarm a bit on AI stock valuations. And I'm glad your team brought this up because we saw large sell-offs this week at Salesforce, Figma, C3I. After earnings, they were okay, but they didn't blow anybody away. Conference calls were okay. Outlooks were so-so. Should investors be concerned about AI valuations at these levels, and why so?
Well, you and I have talked about this before, Brian, but this trade is very nonlinear and volatile in nature. So, when you go from the advent of the idea, when ChatGPT came to the forefront in November 22, to building out the infrastructure layer, to eventually having to build out the application layer of AI, it is not a straight line. And I think what we're seeing right now with AI is that we are clearly moving from a infrastructure layer investment theme towards an application theme. And we are seeing differences between how the applications of AI are deployed by consumers and by enterprises. Enterprises have to operate within strict budget requirements, and you also run into some friction on the employee side with respect to how they use AI in their own individual workflows. We see when you look at consumer AI that people are much more likely to adopt AI in their consumer computing habits than their enterprise computing habits, because they see less potential for that to impact their own earnings power, to be frank. And I think at the end of the day, you're seeing very different skews of how AI is being adopted between consumers and enterprises.
Eric, I'm not sure if you saw this, that the tech meeting dinner last night, the President Trump, it was just the optics were amazing to me. You have Mark Zuckerberg over at Meta sitting next to President Trump and Bill Gates on the other side. It's fascinating theater if you're in media and you happen to cover stocks. Nonetheless, you cover Meta, you've been bullish on Meta shares. Zuckerberg said last night at dinner they plan to invest $600 billion in AI-related capex in the U.S., I believe, through 2028. Is that too much in your view?
Well, it is a greater dollar amount than we have in our financial projections today. Now, the nuance in that is you don't know from the outside looking in how much of these investments are going to be made by Meta themselves and how many of them may be made by third parties, such as private equity firms and private credit and data center companies away from the profit and loss statement of Meta. So I think there's a lot of large numbers being thrown out, a couple of $1 trillion before the end of the decade, hundreds of billions of dollars by individual companies. I think the devil is somewhat in the details of how much of this is actually going to end up on the financials of any one given company, as opposed to elements of private equity, JVs, partnerships. I think there's a lot of that's still to be sorted out.
Is the growth in Meta's businesses, Eric, whether it's Facebook, Instagram, or even WhatsApp, are they supportive of a $600 billion investment in AI capex? I'm trying to figure out what's the next growth catalyst for each of those platforms.
Yeah, well, there's a couple of growth platforms at Meta that we would highlight. The deployment of AI into advertising systems is an area where you can actually today see real benefits of AI driving faster revenue growth. So we wrote a note a couple of months ago talking about how AI can disrupt existing advertising profit pools and highlighted Meta along with Alphabet and Pinterest and AppLovin as companies that could benefit from that broader secular theme, and identified hundreds of billions of dollars of existing industry profit pools that could move towards the digital advertising landscape. Last quarter alone, deploying more AI into their content recommendation engine resulted in a mid-single-digit increase sequentially in engagement, meaning folks like you and I used Instagram more because Instagram's content recommendation engine was being better run through a mixture of AI and machine learning. And there are elements of that we think remain underappreciated that could sustain high teens or 20% growth for longer.
Lastly, Eric, Google's antitrust case effectively over. Is it off to the races for that stock? Because as you and I know, that stock has been trading at a discount to the broader S&P 500 for some time, in large part because of this case.
Yeah, so in a note the other day coming out of that ruling, what we articulated is that you could see Alphabet make a move now towards a market multiple. It does trade around 3 to 4 points below a market multiple today on 2026 and 2027 earnings, depending on how far out in terms of operating estimates you want to use for your valuation metrics. That could push us towards an upside node. We've articulated an upside node in the stock closer to $300 a share against our price target, which is roughly where it's trading today. And as people get more comfortable with the mixture of assets inside Alphabet, what's been interesting about this ruling, Brian, is that the ruling acted as an overhang on the multiple. But if you actually go out and talk to investors like I do every day, most of them want to own Google Cloud, YouTube, and Waymo as exposure to those businesses, but the overhang was on search. With the overhang lifting around search, you do wonder if you end up with a full re-rating of this asset portfolio, as we've talked about in some of our prior notes.
All right, we'll let you go. I know you got a big week, probably a big weekend of prep ahead of Communicopia. Looking forward to seeing you there. Looking forward to being at that conference. Thanks, Eric. Appreciate it.
Take care, Brian. See you out there.
Time now for To Watch in the markets. We're going to start off on the earnings front. A lot of big names reports coming in, including Oracle, GameStop, and Kroger. Oracle announced results for the first quarter on Tuesday. Analysts expecting strong AI demand to propel Oracle in Q1, with Microsoft and CoreWeave showing big gains in cloud services tied to AI that should also benefit Oracle. Investors will be keeping a close eye on spending as well, with Oracle shelling out more on data centers and infrastructure. Moving over to the economy, fresh inflation data coming in on Wednesday with PPI, that's the Producer Price Index. Economists forecasting both total and core PPI to slow to 0.3% on a month-over-month basis. And sticking with inflation, we're also be getting the Consumer Price Index, or CPI, on Thursday. Those numbers expected to show little change compared to July, with headline and core CPI coming in at 0.3% respectively on a month-over-month basis. The new inflation numbers are the next important economic data point for the Fed as it approaches that September FOMC meeting. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour for the latest and greatest market moving stories.